hello everybody and welcome to today's video. So today I want to finish my series titled How I Create My Conviction Weighted Portfolio. And the last part of my series that I have to cover is my tier 3 stocks. And as you know, I have 3 types of stock in my portfolio. I have tier 1, which is 20 to 25%. So that's my highest conviction. I have tier 2. Tier 2 is most of the stocks that I cover on the channel in general. Stocks on which I have high conviction, but it's not the highest. And I suggest you look at the videos I made on these 2 tiers where I go in depth as to how I distinguish a tier 1 from a tier 2. And then I have tier 3, which is what I want to explain today. And tier 3 are my stocks that are more binary in nature, more exponential in nature, and that have an unpredictable growth, where it's really unpredictable to see, how big they could potentially get, because all of these stocks are trading very cheap relative to the disruption potential, but they also have higher risk, which makes them binary, right? These are types of stocks where you could lose everything, and the odds are much higher of losing money. The odds are high, right? Very, very high, but the reward is way higher than the upside you could ever expect from a company like Tesla, as you will see when I go through these stocks. As a reminder, those 3 tiers, is just the growth stock portfolio. I also believe in bond alternatives. So you may know that I'm highly interested in Bitcoin. I do save some money in Bitcoin and savings accounts type stock, like Google, for example, will be a savings accounts type stock. And because this channel is named Beat The Denominator, right? It's all about money supply and beating that flood of new money that is coming year after year. And for that to beat the flood of new money coming after year, I believe it's important to have leveraged real estate, and that would be mostly a primary home, preferably in a state where you can have a homestead, and that you leverage, because that's the third leg of the stool, right? It's kind of a 3-legged stool. So, what are the characteristics of tier 3 of my first category of asset, which is growth stocks? What is the third tier of growth stocks, which represent 5 to 10% of a portfolio, and right now it's closer to 6% for me. So what are the characteristics of these binary bets? Well, first of all, they have a highest risk. They have a highest risk part of a portfolio. They're kind of a risky edge of a portfolio. I require to buy any of these stocks that I do my due diligence, and that I believe in my due diligence, and that I believe in these stocks. I fundamentally believe in all of these stocks. I believe in them, but I'm also aware that the risk is higher. Risk is higher because of things that I typically don't control. Like, for example, macro. Macro is a clear example of very, very high risk for Opendoor. Opendoor went from a fine company, a clear disruptor with consistent growth, to kind of a turnaround play because the macro did a 180 in no time, right? Regulation risks. That could be a risk for Coinbase, which is the other stock that I'll talk in this video, right? There could be ban on certain types of blockchain, which would really hurt Coinbase. I don't have any control over regulation. But there's more, right? There's unpredictable growth over the next 12 months. Like Fiverr. Do I believe distributed work is the future? Do I believe gig work is the future? Yes, but I don't know when that explosion is going to come, right? Roku, I don't know when advertising is coming back. Zoom, I know right now we're in a counter trend where a lot of people are getting back into the office. I don't believe that's the mega trend, but I don't know when the mega trend will normalize again. Ginkgo Bioworks, right? It's all about the molecules that they find. I don't know when they're going to find good molecules, synthetic molecules that they can sell. I don't know. That's a riskier stock. So many of the ARK stocks fit in this category. Some lifestyle stock whose growth has stalled also fit in this category. For example, Figs is a stock that in the long run I strongly believe in, but the growth has stalled right now because of this whole return to to regular business processes, and Figs was selling scrubs. So scrubs were obviously very, very popular in 2020. Now we're coming back to more of a normal routine of life, and so people are coming back to their routines. But the mega trends are intact, and so sometimes they overshoot to the upside or the downside, which make this growth unpredictable. The last type of example of a stock that we fit as a binary stock is one that is linked to to a binary outcome. So an example of that, for example, the classic one is the FDA approval of a drug. Sometimes the FDA will approve a drug and they have a stock go up 80% because they just approved that drug. So that's an example of a binary outcome. But you could also have binary outcomes to the downside. For example, a firm, I have a small position in a firm, but I know it's very risky, because if a firm loses Amazon as a customer, if Amazon were to decide, hey, I'm going to do my buy now, pay later system, then a firm would lose a tremendous amount of business. So there is always something about macro, regulation, growth isn't predictable because of the direction of a megatrend. People get overexcited and underexcited, and also binary risk outcomes. These are all good description of a binary stock. And so it's important for me to realize that, yes, I could lose all of my positions in binary stocks, right? The 6% of a portfolio that I have in binary stocks, it could all be lost, and that would not be a catastrophe. An important point that I want to make is that if you own stocks in a taxable account in the US, right, you get the 15% write-offs. So it's a loss, but it's not technically a full loss, because you can write it off on your future gains. It's only a full loss if you stop investing forever, which is not what I'm doing, right? I'm investing for a very long run, so there will be capital gains, and these losses can be helpful in actually reducing some of your future gains. It's a tiny element of a thesis, but it's important to note that. So the downside we've discussed, pretty clear. Those risks are pretty clear and they're pretty high, and I am fully aware that I can lose some money. But the upside potential could be tremendous, right? There could be a very, very, very high upside potential. And so let's talk about Opendoor, right? Why, for example, why is Opendoor a stock that I own? Well, it's 0.8% of my portfolio, so it's not a lot. Am I crazy for owning Opendoor? I don't think so, because I've spent a lot of time studying Opendoor. Actually, I have more than 30 videos on the channel on Opendoor. This was one of the early on topics of the channel. I've used the product. I've both sold and bought a house with Opendoor. I've used the competing product, which is Realtors, and I didn't like it. I liked Opendoor better. I like dilligence app better. I know the disruption playbook, and I believe Opendoor is placing itself as a real disruptor because they're attacking money. They're attacking that fee that people don't like to pay. When you sell a house, you're gonna have to pay that 6% if you go through the realtor process. Not with Opendoor. You're paying less when you sell a house with Opendoor. So they're attacking that fee, and as a result, they're going after a monopoly because they are tremendously disrupting the cost. They're creating money where money didn't exist in the past. They're questioning accepted conventions of paying 60% to sell a house. They're questioning that convention, and so homeowners accept that, and all of a sudden you have an option to save money out of nowhere, something that didn't exist before. So it's a classic disruption play, right? And the worst that can happen is I can lose 80%. So, right, a bad tweet from Elon Musk, that can have a much more negative impact on the portfolio than Opendoor going out of business for me. So I sleep very well at night. So what is the upside, right? What is the upside of Opendoor? Well, if Opendoor, right, is a 20x, if it goes back to all-time high, and if it's a 20x, that more than alleviates that loss that I was talking about, that 1%, that 0.8% of a portfolio loss. That more than alleviates it. If it goes back to its all-time high, if Opendoor goes back to its all-time high, that would be a 20x, right? And if Opendoor goes to trading at a fair multiple with the guidance that the CEO has given, that would be a 10x. And this was a video I posted about 10 days ago. So one of the questions that I have to ask is this: is Opendoor the future of real estate? Well, right now it seems far-fetched, right? If you go online and you look up an Opendoor, everybody's telling you that Opendoor is going bankrupt for sure. But I know enough about disruption to know that companies have been predicted to go bankrupt over and over again, and things that wouldn't happen have happened over and over again. Uber versus taxis, right? When it first came out, people didn't believe in Uber, and today companies like the Yellow Cab Corporation or the Medallion Corp out of business. Netflix versus Blockbuster, right? That was kind of the same way. Out of business, Blockbuster. Amazon versus a lot of traditional retail, not just books, right? Way beyond books. Look at the state of malls today. Amazon has a lot to do with the state of malls today. Airbnb versus hotels. Airbnb is a low-cost disruptor, especially if you travel as a family. Hey, Airbnb has been the subject of, hate and disliking, sometimes real, often manufactured, very often manufactured, and it's still winning and it's still growing really, really fast. Google versus the libraries versus the experts, right? We don't need a Carnegie library anymore. And right now, we're at the heart of this disruption. Tesla versus gas cars, right? A disruption that many still do not see and still do not understand, but that I believe I see and I understand. And so Opendoor is much more early on in that stage, right? All of these companies, you have a large portion of the population that see them for what they are, but Opendoor, nobody sees it for what it is, and therefore you get a steep discount. I don't find the idea that a company will disrupt realtors to be that far-fetched at all. In fact, in my view, it is more likely than not. That will stop paying 6% at some point, because today we search for our homes on our own with the internet. And so if Opendoor fails, I'll be looking for the next company that tries, because I believe this is one of the next markets that's going to be disrupted, in my view. So the market is of a tremendous size. And even if Opendoor does a little bit of disruption, right, just a little bit, like I put it right here, you could be in a 10x or 20x. But what if Opendoor does a large amount of disruption, right? What if Opendoor is a real disruptor and becomes a real disruptor like Airbnb, like Google, like Amazon? You may say I'm dreaming, right? But I'm paying only 0.8% of a portfolio to dream. So it's okay. That makes sense what I'm saying. It's like, so let me just try to be a little more rational, and you'll see this math boggles the mind. This math makes you look crazy when you talk about this math, but let's just talk about it. 2.8 trillion of real estate transactions in 2021. Realtors, out of 2.8 trillion, they grabbed 168 billion through listing fees, through 6% listing fees. Opendoor comes and it's cutting those fees by 1% to grab market share currently, but they will cut the fees more. Let's assume that Opendoor cuts the fees by 2%. The question is, how much market share would Opendoor grab? How many people would give up their realtors to save 2%? And I would argue a lot of people. I certainly would prefer to sell a house through Opendoor and pay only 4% or 5%, depending on where they are in that era. Knowing that, by the way, the CEO in the recent call talks about down the road, it will be lower than 5%. Down the road, they will lower it, obviously, because technology scales. The best app scales for nearly free. So let's just assume that their technology, their stack, their best app scales, and that they were to grab, I don't know, let's dream, 10 years from now, what if they grab 20% of the real estate market, right? In the US, just the US, right? That would be $2.8 trillion of today. Well, that would be much higher in the future, but we're not going to guess what it would be, what real estate transaction would be in the future. So let's just, for the sake of simplicity, let's just use today 2.8 trillion times 20% times 4%, which they would be charging to grab market share from realtors who charge 6%. That would be $22.4 billion in high gross margin fees, right? These would be fees earned, and they would have high gross margin, right? Probably 80%. Right? And then you do 22.4 times 80% times 16, which is the current multiple of enterprise value to gross profit in my universe. That's the current multiple. And if you apply that multiple, you would get an enterprise value of $286 billion. And, the market cap would be just about the same if you assume no debt. And if you assume a zero net cash position, that'd be about the same. It'd be actually a little higher, actually. But, 286. So you're looking at a company that right now is trading at 900 million. Right? Companies trading at 900 million, I do a simple back of a napkin math here, assuming that they could grab 20%, which, by the way, technology is much more monopolistic than regular businesses, right? It's not hard for us to think of apps that are much more than 20% marketplace. So, I realize that sounds crazy, but, It's probably sounded crazy to predict that Tesla would be as big as it is today back in 2017. It probably sounded crazy to predict that Amazon would be as big as it is today back in 2002. Most likely sounded crazy to predict that Uber would kill the taxi back in 2011, or that Netflix would be so huge back in 2007. Right? That's kind of the nature of this type of investing. These businesses are so disruptive. If they survive and if it works, your upside could be more than 100x. I mean, and I'm not saying any of this will happen. In fact, a lot of these companies are going to go to zero, and I'm okay with that. But you're getting an option. You're getting an option on an insane future. So anyways, today is not a video on Opendoor, of course, and you may disagree with me. That's perfectly fine. My point today is not to talk about Opendoor. My point today is to convey that there's very high risk, and for Opendoor, for example, it's 0.8% of our portfolio. But that risk is lower for me because I've used the product twice. I've compared it to the competition. That's lower risk. I know the product. I've studied their balance sheet. I have a full video. I don't think bankruptcy is coming. My strongest belief, to the point of naming this channel Beat The Denominator, my strongest belief is that the Fed will resume monetary printing. And when it does, 2021 will look like a slow year. So that's in line with my belief, And for that risk I'm taking, there's an upside potential that most would not dare to even believe in. So I am consistent with myself, which is what matters. I am consistent with myself. This is thinking on my own. And this is not listening to articles on various websites saying that Opendoor is going bankrupt or things like that, which, these articles are mostly written by robots, by the way, who do not know the difference between GAAP and non-GAAP accounting, right? Because this is a company that's posting terrible GAAP results, but you got to look under the hood and you have to look at the cash flows. Anyways, I've done my due diligence. I am consistent and I have risk management. So if you have high risk but a tremendous amount of reward, if you do your due diligence and you have good risk management that doesn't sink your whole portfolio if it were to happen, I believe it's okay to own a tier 3 stock. And that is why I own a tier 3 stock like Opendoor. Good risk management, same due diligence, upside potential required much higher than my tier 1 stock like Tesla, right? Tesla, I expect a 10x. A 10x is what I'm seeking with Tesla. This, I'm seeking much more than a 10x. So it makes sense, right? So moving on to another example. Another example that I have, for example, is Coinbase. So Coinbase is just a tad under 1% for me. I'm like at 0.998 or something, just a tad. And I made a video on Coinbase, a 1-hour video explaining my full thesis of Coinbase. And I'm clear. Coinbase is a risky, but very long-term bet. It's a risky long-term bet. Let's talk about Coinbase a second. So Coinbase, kind of the same chart that I'm showing you for Coinbase as I did for Opendoor. If Coinbase goes back to its IPO level, roughly, that would be a 5x. If it doubles from its IPO level, that would be a 10x. So major potential in very little time, in my view, because crypto can turn around extremely fast. And of course, you may tell me, but crypto is dead. Yes, crypto is dead. Of course, it is dead. Actually, you can see on BitcoinObituaries.com, they count how many times prominent people, news sites have called it dead. And right now we're close to 500 times. Actually, this article is a little old, but at the time of publishing, like a few months ago, it was 466 times. So Bitcoin has been told to be dead for the longest time, and every week Bitcoin is dead, and of course it's not, right? Of course it's still around. So that would be one of the things. Like, what's your view of Bitcoin, right? To me, Bitcoin is not dead and it's not going anywhere. And so Coinbase derives about 30% of its revenue from the Bitcoin ramp, right? From the whole idea that if you want to get into the Bitcoin ecosystem, you have to go through an on-ramp, right? Through an exchange, and Bitcoin is the exchange that most people will choose in the United States. So my catalyst for Coinbase, just like for Opendoor, they're very uncertain, right? It's tough to know what's going to happen. It's tough to know how large this company could get, and there's a lot of risks with Coinbase, right? It could be banned. A lot of cryptos could be banned. SEC could put regulations, but we don't know how big is the upside. But I can tell you one thing: is the upside it could be really, really big. And if you go to my video, right, there's a few reasons why. But first of all, the Bitcoin halving is coming in 2024, probably in April 2024, which means that the Bitcoin supply will be cut in half. This is good for an exchange. When an exchange has twice fewer items to sell, the prices go up. So this will be good for Coinbase, and that's 2024. That's one catalyst. Another catalyst, which actually is a major part of my thesis in Coinbase, is the digital dollar. And so they own 50% of USD coin, USDC, and because of that, because they own 50% of the consortium, they're entitled to 50% of the revenues from the consortium. And so USDC is a digital dollar. It's a dollar on crypto rails that moves on the Ethereum blockchain. And they've earned, $327 million in 2022 on 42 billion of issued USDC. So they've earned 327 million on 42 billion of issued CNBC. And that's recurring income, by the way. And it varies on the Fed interest rates. And sure, as the Fed cuts interest rate, this will most likely go down. But they will always earn a little something from that. And I think the bigger story here is when you look at USDCs, is do we think that digital dollars are going to be a thing? I don't know. I have no idea of that. But I can tell you that if it becomes a thing, there's $86 trillion in circulation out there. If you look at M2 money stock and euro dollars, $86 trillion, right? When I do a simple 86,000 billion divided by 42 billion, I'm getting at a potential market for stable coins, for digital dollars, that's more than 2,000 times bigger than today. And USDC's market share is about 30% right now. 20%. So what does that mean, right? How much bigger could this get, right? This is multiple hundreds of times bigger that this could get. So the upside could absolutely be insane. You could be buying a piece of the infrastructure of the US dollar of the future, right? So in my view, owning Coinbase, I don't even need to have an opinion on Bitcoin to own Coinbase. I could have an opinion on US dollar to own Coinbase. But that's not it. They're the last very large exchange standing in the USA. FTX went bankrupt, right? They are the largest validators of blockchains in the world. Coinbase Cloud, the AWS of blockchain. If you follow crypto, if you follow layer ones, look up the validators. Coinbase is going to be a top one. Almost all the time, it's Coinbase. So they earn these staking revenues. They are kind of an AWS of blockchain. And so of course, a lot of blockchains are going to fail. But what about the few that survive? You're buying a piece of the underlying infrastructure in the future, in my view. And let's see, they're an institutional asset manager, right? They're available in BlackRock's Aladdin. So BlackRock's Aladdin is their main, the main, terminal that a lot of hedge funds use to invest. So it's a company that has a lot of external validations. So again, there's a lot of risks in crypto, but to me that upside outweighs the risk of losing just a tad under 1% of my portfolio. So yes, Coinbase has all sorts of risks, but it also has a potential that boggles the mind. Thinking mind, the digital dollar could be 2,000 times bigger than it is today if it becomes a thing. Right? Think about stable coins alone, how big they could get. Think about the option on any successful blockchain. There will be successful blockchains out there, more successful than they are currently. Think about the partnership with BlackRock. There's more to come. This is part of a thesis. Nobody talks about that right now. But one of the big questions that we have to ask ourselves is, will stocks be tokenized in the future, right? Will companies go through computer share to list their shares to exchanges? Will computer share and the current broker system be the same in the future? Or will companies simply put their stocks on blockchains? And you'll have the stock moving on a blockchain, being exchanged on a blockchain 24/7. Right? I don't know if that will happen, just like I don't know if stable coins will happen. But if I know that if any of these things happen, it could be absolutely huge. It could be tremendous. And so once again, I'm not saying, like, of course these are high risk stocks that are high reward, but for me it's all about the consistency with myself. I am consistent with myself. It's a space that I believe in. Because I'm a macro guy. I love macro, and I see the value of Bitcoin. So it's a space that I believe in, even if it's out of fashion today. I still buy Bitcoin regularly, even if it's completely out of fashion today. Right? Actually, I was buying Bitcoin in 2014, and like most people who bought Bitcoin in those early days, they sold it all and thought they were real smart. So I sold all of my Bitcoin. I sold in 2015, and I thought I was really smart because I was seeing all of these articles, and I was at the university back then. I had university professors bashing it, and I thought I was really smart. Oh yeah. It's absolutely not the future. No. That was not thinking for yourself, right? I think for myself. So now, obviously, I'm not selling my Bitcoin ever, right? I've used Coinbase, I've used several blockchains, not just the BTC layer one, right? And I know down in my heart that the technology is a real innovation. So it's all about consistency with yourself, right? This wouldn't make sense if you don't believe in crypto whatsoever. This wouldn't make sense. Or if you're a realtor and you love realtors and you have realtors in your family, it would not make sense to invest in Opendoor, right? It's kind of the same thing. So you have to be consistent with yourself and think for yourself. And so I'll finish with this. It only takes one binary stock to succeed for your portfolio to explode higher. A 1% position can become a 20% position, a 50% position, or even bigger over the long run if you are right. 1% moving to a 20% position, that's a 20x. So I have strong conviction in all of my binary stocks. I just accept that I have higher risk of losing everything, which is why I'm only comfortable putting 5% to a portfolio exposure. I'm not comfortable with any more exposure, right? Because you invest for your future. Right? They're not sure bets, and I fully know that. If they go to zero, I need to not be hurt, which is why the position is so small. And I'll conclude with some parting thoughts here, which is Cathie Wood. Cathie Wood, almost in my view, exclusively invests in these type of binary stocks. It's almost exclusive. If you listen to Cathie Wood talk about Tesla, she will mostly talk about full self-driving. And the fact that when Elon Musk turns on full self-driving, you'll have self-driving cars and you'll have robotaxis. That is the core reason why Cathie Wood is invested so heavily into Tesla. That is not the reason why most investors buy Tesla. She's invested in Tesla because of a binary part of that investment, just like she's invested in so many different stocks because they are inherently exponential / binary stock. And using her ETFs as proxies for these binary stocks. By the way, I own ARK W, which is why I put it in there. I don't own ARK K because I don't like I think healthcare exposure in ARK K is just too high and too risky for my taste. So I don't own ARK K, but I own ARK W, which is her second most popular ETF. And when I look since the launch, right, this is the real data as of today. Since the launch, ARK W is actually just a tad ahead the triple Q. But keep in mind, this is with the madness undervaluation that we've seen due to macro. I do not believe this is a normalized trajectory for the ARK ETF, right? If you look at my cursor, the ARK ETF should be probably more in the middle. This is a not normalized, this is a highly depressed valuation. So what I'm trying to say here is that the performance over the long run has demonstrably not been that bad, not been that bad at all. If you had bought throughout 2014, throughout 2015, maybe as high as 2016, if you had bought that company, you'd still be way up, just as up as if you have bought the Nasdaq. And ARK, which in my view is kind of a riskier ETF from Cathie Wood here, ARK performs in line with the S&P 500, despite the major up and the major down. So we need to zoom out when we judge these strategies, and we need to greatly zoom out. And that's what I do. And I'm fine with zooming out. So I hope that helped you understand kind of why I have some stocks on this channel that I cover that would seem more risky or would seem even out of place. You just know that they are binary stocks, and so there's proper conviction weighting which manages risk, right? I would never, my position in Tesla is almost a quarter of my portfolio. I would never put a quarter of a portfolio in a binary stock, ever. Right, it's this goes for the highest conviction, but I'm fine. I'm fine putting 0.5%. I'm fine putting 0.8% in a stock that can have a tremendous potential and that can be 20, 30, 100x. So anyways, that's the conclusion of this video. This is obviously not investment advice. This is just entertainment. Thank you so much for watching. Please like, please subscribe, and have a wonderful day. Thank you.